Most people spend their entire lives trying to earn more money. Almost nobody stops to ask what money actually is, or why the rules seem to change once someone has enough of it. Earning and building wealth are not the same game. One is about income. The other is about what happens after the money arrives, how it moves, what erodes it, and what quietly multiplies it. The first game is taught in school. The second one mostly isn't taught at all. A salary feels like progress. The number in the account goes up. Something is clearly working. But money on its own is mostly two things. It is a medium of exchange, a way to trade your hours for someone else's. And it is a temporary store of purchasing power, a placeholder for value until you decide to use it. Currency does not work because the paper is valuable. It works because everyone agrees to accept it. That agreement is durable, but it is not the same thing as an engine. Cash sitting still does not build, it waits. That distinction is quiet, and it is expensive to miss. Ask anyone what a loaf of bread cost when they were a child. The number they say is almost never the number on the shelf today. Prices drift upward over long periods. Wages usually drift upward too. When the general price level rises, each unit of currency buys slightly less than it did before. In a single month, that is invisible. Across decades, it is the entire story. This does not make cash useless. Cash is liquidity. It is optionality. It is the money you need when the roof fails or the job ends. And an emergency reserve is one of the most practical things a household can hold. But cash is a tool for the near term, not a vehicle for the long one. Held still for 30 years, it is a slow leak. This is where most people stop looking, because the machinery seems technical. It isn't. Banks take deposits and make loans. When a bank issues a loan, it credits an account, and the total deposits in the system expand. That sounds strange until you notice how tightly it is constrained, by capital requirements, by regulation, by the borrower's ability to repay, and by the cost of borrowing that central banks set. Interest is the price of time. Lenders charge it to be paid later instead of now. Borrowers accept it to have something now instead of later, which means debt is neutral. It is a lever. Borrow to acquire something that produces income or holds its value, and the debt can work in your favor. Borrow to buy something that loses value the moment you own it, and you spend years paying for the past. The same instrument, opposite outcomes. Assets are the part of the system that produces rather than waits. Ownership in a business. Broad participation in public markets. Property that earns rent. What they share is output. A business generates profit. A tenant pays rent. A market index represents a claim on the earnings of real companies doing real work. When you hold an asset, you are not holding a placeholder for value. You are holding a share of something being made. That comes with a cost, and the cost is real. Businesses fail. Property sits empty. Markets go through stretches that are genuinely punishing, and they do not rise on a schedule to suit anyone's plans. Risk is the entry fee. It is never removed. It is only chosen, understood, and sized. Compounding is the part that sounds boring right up until it doesn't. The idea is simple. Returns begin producing returns of their own. Early on, almost nothing appears to happen. The line looks flat. It feels like patience wasted on a rounding error. Then the curve begins to bend, because each new gain is calculated on a larger base than the one before it. The math has not changed, only the size of what the math is working on. Time is the active ingredient, not brilliance. Compounding does not reward the cleverest participant. It rewards the one who stays in, keeps contributing, and does not interrupt the process. Interruption is the most common way it is lost. So most people are taught to earn. Far fewer are taught what happens next. That purchasing power erodes, that credit finances ownership, that assets carry risk and reward, and that time does work no salary can imitate. None of this is a shortcut, and none of it is advice about what to buy. There is no hidden door. There is only a set of rules that operates whether or not anyone explains them to you. Money is only one piece of the game. Understanding what happens after you earn it is where wealth begins.